Okay, thank you very much for inviting me here and look forward to getting some feedback. So it's called Recovering Heterogeneous Beliefs and Preferences from Asset Prices. It's joint work with Arthur Korteweg from USC and King Shu, who is a graduate student at McGill. So let me start by giving you a broad motivation for this topic. So as we all know, asset prices reflect investors' risk preferences and their beliefs. So in this context, risk preferences refer to investors' differential discounting of different possible states of the world. And her beliefs refer to her perceived likelihood of occurrence of each of the possible states. So therefore, given this central role of beliefs and preferences, so understanding how beliefs are formed, how they evolve over time is quite central to explaining and predicting the behavior of asset prices. And of course, beliefs and preferences also form the two central ingredients to economic models that are designed for that are aimed to design optimal economic policies. And given this central role of beliefs, a lot of research effort has been devoted to understanding how they are formed. Two central paradigms have developed. The first is rational expectations, which purports that economic agents use all available data objectively or rationally to form their beliefs about the future. And the second class of models are the behavioral models, which assert that agents have certain behavioral biases which cause their beliefs to be distorted relative to the true data generating process. Okay? Now, models based on either paradigm, so rational models or behavioral models, need to make structural assumptions about the true data generating process. So in rational expectations models, the rational data generating process corresponds to the beliefs of the investor. And then for behavioral models, we need assumptions about the true data generating process and also assumptions about how investors' beliefs deviate from the true data generating process. Now, of course, these assumptions are largely driven by analytical tractability rather than being optimally chosen in terms of fit and are prone to misspecification. Also, most theories assume that investors are homogeneous, either in terms of their risk preferences or in terms of their beliefs or both. And there is a lot of evidence of investor heterogeneity. So one can refer to the early survey article of Barbaris Taylor that talks about the huge volumes of trading in organized exchanges, which is very much indicative of investor heterogeneity. This paper of Campbell et al., which shows different investors have very different optimal portfolio holdings, again indicative of either heterogeneity in preferences or beliefs or both. There's Malmendia and Nagel, which shows that individuals' portfolios seem to be related to their own past experiences. So if investors experience very severe economic downturns or financial downturns during their formative adult years, they tend to allocate less to stocks. Okay. And finally, there is a more recent evidence of investor heterogeneity from Greenwood-Schleifer, who look at investor surveys. So these surveys are, they've recently been conducted in the US, where a group of investors are asked to state their beliefs about the stock market. So they're asked questions such as, what do you think the return on the S&P is going to be over the next few months or next year, next couple of years, and so on. And those have also revealed substantial heterogeneity, as I will show you in the next slide. So there are some surveys. So the Greenwood and Schleifer look at 6 different surveys of individual investors. So these are surveys where a group of professional individual investors are asked to state their beliefs about the stock market. So here are some examples. So there's the Gallup survey. So Gallup is a well-known organization in the US that conducts surveys. You may have heard about them in the context of the presidential election, for example. So then this is called the American Association of Intelligent Investors. This is another survey. This is a survey conducted by Graham and Harvey. So this is a survey of the CFOs of top corporations. And finally, this is Robert Shiller's individual investor survey. So the numbers I have here are basically correlations of these beliefs with NBER recessions. So basically what you can see is that these correlations are negative, which is basically indicative of pro-cyclical beliefs, right? So basically, if the stock market is doing well, so we are in an expansionary phase of the business cycle, then these investors say that they expect the returns to be even higher over the next year. Okay? And then during downturns, during the recessionary phase, when the price is low, so the realized return is low, they say that the returns are expected to go even further down over the next year, right? So basically, it's pro-cyclical beliefs about the market. Now, if one looks at certain surveys of institutional investors, then the beliefs seem to be counter-cyclical. So this is Robert Shiller also has an institutional investor survey. So where the individuals surveyed are basically money managers. And those surveys are basically negatively correlated with the Gallup survey, for example. And it has a positive correlation with recessions, right? There's also a second survey, which is the Livingston survey, which also is has positive correlation with recessions, suggesting counter-cyclical beliefs, right? So basically, the main takeaway is certain surveys, mostly individual investor surveys, point to pro-cyclical beliefs about the stock market, and certain institutional investor surveys point to counter-cyclical beliefs about the market. Okay, and perhaps even more importantly, these speak of investor heterogeneity. Right? Now there is some concern about surveys because these surveys are typically conducted over relatively short time periods. Second, there's a relatively small size of the cross-section of respondents for each of these surveys. And there's also limited information on the identities of the respondents. So there's a concern about the reliability of the respondents. Okay? But certainly the picture that emerges is that there's substantial heterogeneity amongst investors that are responding to these surveys in terms of their beliefs. So now let me turn to the contribution of this paper. So what we are going to try to do in this paper is we are going to propose a framework, an econometric framework, to recover the subjective beliefs and risk preferences of different types of financial market investors. Okay? And we are going to do so without the need for assumptions about the true data generating process, right? So we are not going to make any parametric assumptions about what is the data generating process that generates the data. And we are not going to a priori make any assumptions about investor rationality or lack thereof. Okay? So what do we mean by beliefs? By beliefs, what I'm going to show you is we are going to recover the entire conditional distribution of certain macroeconomic or financial variables as perceived by different investor types. Okay? So suppose I am in Q1 2024. I'm going to tell you what is the perceived distribution of the stock market in 2024 Q2 by different investor types. Okay? And I'm going to need 3 inputs. So I'm going to need an SDF, which is going to summarize the investor's risk preferences. Okay? So the SDF is going to be a function of certain unknown parameters, which I will estimate. So those parameters are also different for different investors because they can also have different risk aversion levels. I'm going to need a cross-section of test assets. So basically, you can think of this cross-section as this should reasonably span the investment opportunity set of the different investor types. And finally, I'm going to need a conditioning set that investors use to form their beliefs. So given these 3 inputs, an SDF that summarizes investors' risk preferences, a cross-section of test assets that spans her investment opportunity set, and a conditioning set, which she uses to form her beliefs, I'm going to recover her beliefs and risk preferences. So these recovered beliefs are going to be price consistent And what do we mean by price consistent? They're going to satisfy the conditional Euler equations for the test assets for each investor type. So basically, in this sense, the beliefs and risk preferences that we recover are going to be consistent with the investor's optimal portfolio choice. So given these beliefs and risk preferences, the investor optimally chooses to invest in the portfolio that she holds, right? And if beliefs and/or risk preferences are recovered to be different for different investor types, then the optimal portfolios are basically also going to be different. And basically, this approach overcomes the shortcomings of existing survey data on investors' expectations that I just mentioned. So they have relatively short time periods over which such surveys are conducted, a small cross-section of respondents, and scarcity of information on the identities of the respondents. Now, so how do I identify these heterogeneous beliefs and risk preferences? So it comes from the observation that investors with different risk preferences and/or beliefs will choose different optimal portfolios. Okay? So because investors with different risk preferences and/or beliefs will optimally choose different optimal portfolios, this observed heterogeneity is what allows me to separately identify the beliefs and risk preferences of these different investor types. Okay, so let me kind of give you a very, very broad overview of the results. What we find is substantial heterogeneity in both the risk preferences and the beliefs of different investor types. Okay, so recall I showed you that certain surveys have pro-cyclical beliefs about the stock market and certain surveys have counter-cyclical beliefs about the stock market. So we are going to recover pro-cyclical beliefs for certain investors, counter-cyclical beliefs for certain investors. And moreover, I'm going to be able to tell you what investors have pro-cyclical beliefs and which investors have counter-cyclical beliefs. Okay? So here, so what we find is investors allocating heavily to the large market cap stocks, like investors in the S&P 500, or investors in primarily value stocks, like value investors. Okay? So they have strongly counter-cyclical beliefs about the stock market. You know, so our models, so if you think of standard representative agent consumption-based models, so in these models, the expected market returns are strongly counter-cyclical. So it's either because the price of risk is high, or like in habit models, right? So where people become more risk averse during bad times, so they demand a higher return. Or there are certain other models like long run risk models or rare disasters models when the quantity of risk goes up during bad times, and that causes investors to demand a higher return during bad times. But regardless of whether it's the price of risk or quantity of risk, because the price of risk, because the premium demanded in bad times is higher, then the models generate counter-cyclical expected returns, right? So what I argue is that these are consistent with the beliefs of the investor in the aggregate stock market, which is what our models are designed to explain, right? And it's also consistent with the beliefs of value investors. But however, these are not the only investor type in the market. So what I will show you is that growth investors and momentum investors have pro-cyclical beliefs. Okay? And basically, I'm going to argue that our results offer a reconciliation of the findings in Greenwood and Schleifer. So basically, we can reconcile the pro-cyclical expected market returns found in investor survey data with the counter-cyclical expected returns, which are implied by rational expectations representative agent models. So Greenwood-Schleifer, based on the observed pro-cyclicality in the surveys, argue that our representative agent consumption-based models are misspecified because they imply counter-cyclical beliefs, whereas in the data, in survey data, which are more direct estimates of beliefs, there is evidence of pro-cyclicality in the beliefs. And we are also going to be able to reconcile this anomalous behavior of this small growth portfolio and momentum portfolios. So as you know, so these two portfolios in particular produce large alpha, so they're hard to explain using rational models. So this small growth portfolio gives a large negative alpha with respect to standard, linear factor pricing models like the CAPM or the Farmer-French 3 and 5 factor model. And on the other hand, this momentum portfolio tends to give a large positive alpha with respect to these factor models. Okay? So I'm going to argue that that investors in these risk factors are basically a different investor type with a very different beliefs and risk preferences relative to the investor in the aggregate stock market. And that is why models that are designed to explain the behavior of the aggregate market have a hard time explaining these returns. Okay, so let me delve into the, I'll go into the methodology. So I guess we've seen this equation many times today. So the absence of arbitrage opportunities implies the existence of a strictly positive pricing kernel M, such that the expectation under this probability measure P of the product of the pricing kernel and a vector of excess returns is 0. Okay? So FT denotes the investor's information set at time t. Now, if investors are fully rational, then P, so then this probability measure here denotes the objective data generating process that coincides with her beliefs. Okay? And on the other hand, if investors have certain behavioral biases, then P denotes her subjective beliefs, okay? Which is going to be different from the objective data generating process. Now, this was in the context of all investors being identical, right? Now, suppose there are different investor types. So different investor types can have different risk preferences, they can have different beliefs, or they can have different both, right? So, and we allow for both. So I'm going to have, so this M is the pricing kernel that's going to summarize her risk preferences. So that's going to have an L subscript to denote that it's different for each type L. Right? And similarly, each type L can have different beliefs. So this P, this probability measure here, is also going to have a superscript L. Okay? So basically, different investor types L can have different beliefs and or risk preferences. So now there's one assumption that I need to make to be able to separately identify these risk preferences and beliefs. I need to make an assumption on the functional form of risk preferences. Okay? So, and I'm going to make the standard assumption that M is a function of a vector of risk factors, and gamma represents the risk aversion levels with respect to each of the risk factors. I will come to that, yeah. So basically the objective is to recover the risk aversion level gamma L and the beliefs PL from observed asset prices for different investor types L. Okay, so this is the method. So it's basically a smoothed, what's called a smoothed Cressy-Reed divergence minimization, of which the smoothed empirical likelihood estimator of Kitamura et al. is one member, basically. Okay? So let me kind of briefly explain what this is. So the first step is to approximate the physical data generating process. Okay? So the physical data generating process I'm going to refer to as the objective DGP. Okay? So I'm going to approximate this physical data generating process with a standard kernel density estimator. Right? So this is, so X is basically the conditioning set. Okay? And that so the history of X determines this kernel density estimator of X. Okay, so this kernel density estimator is a measure of the objective beliefs of the investor. And it's simply based on the historical time series of the variables in her information set. And then so given these objective beliefs, her subjective beliefs is basically this T by T transition matrix of P's. So you can think of PJK is the probability of transitioning from state J at time T to state K at time T plus 1. Okay, and basically this transition probability matrix is going to be estimated to minimize, to minimize this Kullback-Leibler information criterion divergence between the objective beliefs and the subjective beliefs. Okay, and subject to the constraint that under the estimated subjective beliefs, the asset pricing Euler constraints are satisfied. Right? So remember, the asset pricing Euler constraints are basically the investor's first order conditions, right? So basically the recovered beliefs are going to be consistent with the investor's optimal portfolio choice because they satisfy this first order condition, right? Now, let me give you a little intuition on this. Now, suppose that the investor is rational, is like fully rational. So basically, in that case, this Euler equation would be satisfied with the objective beliefs omega, right? Now, in that case, the optimal solution to this is to set P equal to omega, and the clique would be 0, right? But now suppose the objective beliefs do not satisfy the Euler constraint. Right? So then the subjective beliefs will be distorted relative to the objective, right? And this estimator identifies the subjective beliefs, which will be minimally distorted relative to the objective. So what is the minimal distortion relative to the objective that we need in order to match asset prices? Right? Yeah, so this is basically what I have here. So the recovered subjective beliefs are minimally distorted in the sense that they minimize this clique divergence with respect to the physical DGP while also satisfying the conditional Euler equations. Okay? And we think that, this is a natural starting point. So this point estimate of subjective beliefs is a natural starting point in the analysis of subjective beliefs. Right, so we have made no parametric assumptions on the data generating process, and we have made no assumptions on investor rationality or lack thereof. Yeah. Yeah. Right.
So what are those things?
What are
those things?
Oh, they correspond to the sample realization. So basically, every sample realization is a state.
So these are based on, because T is based on sample historical period.
That's right.
There will be so many infinite number of that.
Of course, yes.
The future is going to be a repeat of the historical.
Yes, or close to the, like basically every future state will be sufficiently close to at least one state observed in the sample.
So
yes,
when you are talking about conditional, you are actually assuming this matrix a constant. Conditional is only different in terms of each state you are in.
Yes, so there's a stationary underlying distribution. Yes, absolutely. Yes. So that it's possible to learn about the future from the past. Yes,
so because my concern is, a different sample period, you're going to get different answer of this omega JK and PJK. Today, I think Ian was talking about anomaly changing, right? So if you're looking at different sample period, you're going to get what you call objective. May not be really objective.
Certainly. So so the response is very well taken. So the response I would give to that is our approach is actually amenable to using a very long sample, right? So we can use a very long sample that covers many different types of episodes, and then so it doesn't. So actually, unlike surveys, which are only available for like 5 years, 10 years, 15 years at most, here we can use the entire post-war period, for example, right? So you can use like 80 years, like 70, 80 years of observations. Yeah.
So my concern is some of the main things that we do in optimal portfolio is expecting better, all those things.
Right.
That even with very long sample period, you can decide. So I'm not entirely sure that coverage will be accurate in that sense.
Yeah, we do have some out of sample exercise as well in the paper. I don't have time to show it here today, but it performs relatively well out of sample as well for like even different asset classes altogether. Yeah. Okay, so I think I already explained this. So in the absence of Euler restrictions, the optimal solution to the beliefs would simply be this kernel density estimator. So that's the objective beliefs. And then in the presence of Euler equation restrictions, the recovered beliefs would be distorted relative to the physical data generating process. Now, it turns out that this problem has a very, very elegant closed form solution, basically. So, and this is the solution. So these transition probabilities, the subjective beliefs are basically these objective beliefs distorted by this denominator. Okay, and this where this Lagrange, so these lambdas are Lagrange multipliers associated with the conditional Euler constraints. So basically at each point in time, so for each state, we basically do this unconstrained optimization to get the Lagrange multipliers. And then we put these Lagrange multipliers back in here to get the transition probabilities corresponding to a given state, right? And then we repeat this for every state to get the T by T transition matrix. Yeah, so now let me turn, so that was about the recovery of the risk preference, of the beliefs. Now note that these beliefs depend on the risk aversion parameters. So they also depend on preferences. Okay? So how do we estimate preferences is this way. So the SEL, the smoothed empirical likelihood estimator of gamma, is defined as the value of the risk aversion parameter, which basically minimizes the profile relative entropy over the entire admissible parameter space. Yeah, so this approach searches for a risk aversion that minimizes the profile relative entropy over the admissible parameter set. Yeah.
df can be very small.
For certain states can be very small, yes.
So maybe you want to trim.
Oh yes, we actually do some trimming, yes. Okay, so let me now turn to the empirical results. So I guess Ilse asked about what are the specifications. So we need three inputs, I told you. So we need a pricing kernel. So we need an SDF to summarize the investor's risk references. So I'm going to assume that the stochastic discount factor of type L investor is going to be exponentially affine in her return on total wealth. So this is in line with, a very big literature on SDFs. And what is her return on total wealth is given by this equation here. So we are going to take this market portfolio as the benchmark. Okay, so this market portfolio is the benchmark return, and then different investor types L are going to be defined as tilting to their specialized portfolios L. So basically, a given investor type L is going to allocate a certain proportion of her wealth to the market, a certain proportion of her wealth to her specialized portfolio, and the remainder to treasury bonds, like short-term treasury bills. Okay. Now, what will be the conditioning variables? The conditioning variables will be the past returns on these assets. And we consider different, there's some disagreement on the literature on whether immediate past is relevant, which is what Greenwood and Schleifer argued, and whereas and certain other authors like Malmendier and Nagel argue that the entire past is relevant. So even if investors had a very bad experience 30 years ago, it still influences their behavior in the future. So we are going to do both. The results are not very sensitive. So we are going to consider the average of the last 4 quarters of returns on these assets as one conditioning set, and we are also going to consider an exponentially weighted moving average of the entire past. It's not, the results are not very sensitive. And finally, the test assets are the returns on these assets in excess of the treasury bill. Okay. So our data is going to be quarterly US data from 1972 to 2018. We also have robustness tests that extend back to the entire post-war period. Now, what are our investor types? The first investor type is going to be the type that's commonly studied in economic models. So this is the investor for whom all of the wealth is invested in the market, right? So you can think of this investor as the representative investor in the aggregate equity market. So this is the investor that our representative agent models are designed to explain. Okay? So that's going to be our benchmark. And then we are going to be considering certain specialized investors. So this is what we call a type SG. So SG stands for small growth. So this investor tilts toward this small growth portfolio. Okay? So this small growth portfolio is often viewed as a public market analog of private venture-backed companies. So it's a portfolio which has been proven very hard to explain using standard models. So it gives a very big negative alpha with respect to most linear multi-factor models. Then the third and fourth investor types are going to be value investors. Okay? And just for robustness, we are going to show you results for both small value investors and also big value investors to show that results are not sensitive to size. Okay? So like value investors seem to have very similar beliefs, whether or not they choose small size stocks, small value stocks versus big value stocks. And finally, we are going to consider momentum investors. And for momentum investors, so momentum is a long short strategy, right? So for the momentum investor, the specialized portfolio is the return on this zero cost winner minus loser portfolio plus the risk-free asset, okay, to make it 100% invested. Okay, so let me show you first estimates of preference parameters, okay? So let's look at the big investor. So this is the investor in the aggregate equity market. These are her risk aversion parameters for the two different conditioning sets. So remember the conditioning sets are set 1 is just the average of the last 4 quarters and set 2 is the average of the entire past. It's not very sensitive to that. Now, the next line is the small growth investors. You see they are substantially less risk averse. Actually, their risk aversion is not statistically different from 0, right? And these are likelihood ratio tests for the two different information sets that the risk aversions of the two investors are equal, and we strongly statistically significantly reject this. Okay? Now, next, value investors. So these are the lines, rows 3 and 4. So value investors are very similar to the market investors. So their risk aversion levels are between 2 and 2.4, so very close to 2.9, right? And not statistically different from those of the market investors. Okay? And finally, the last 2 rows show results for the momentum investor. We see that actually momentum investors have a higher risk aversion than the market investor. Okay? And these results are also, these differences are also all significant at the 10% level, right? So to summarize, what we show is that large cap, which is the market investor, and value investors have similar risk preferences, and small growth investors are considerably less risk averse, and momentum investors considerably more risk averse than the market investor. Okay? Now here are the beliefs. Yes. Yes, yes. Yeah. Yeah. Yes, we put all the assets in. Yes. When you say test assets, only market E and market SG is not correct. Yeah, thanks. Yeah, that's a typo. Sorry about that. Yes, actually the test assets are all the assets and the information set is all the assets. Okay. So yeah. The only difference is the SDS. The optimal portfolio. That's correct. That's right. Subset of the assets. That's right. And when you actually add to the estimation, exactly. For each of the investors, each type investor divides all the assets. Correct. Exactly. But they optimally choose to invest in different assets. Yeah. So these are the beliefs of the market investor. So the market investor is the black line, and the red and the blue lines are the beliefs of the value investors. Okay. So remember, we recovered the whole distribution. So we can calculate the investor's perceived expected market return, the volatility of the market return, the Sharpe ratio of the market return, the skewness, and everything, right? So in panel A, we have beliefs about the expected market return. Panel B is beliefs about the volatility. C is beliefs about the Sharpe ratio, and D is beliefs about the skewness, right? So what I want to summarize here is that the beliefs are quite similar across the market investor and value investors. In particular, they have counter-cyclical expected market returns and Sharpe ratio. So if you look at panel A and panel C, you clearly see a counter-cyclical pattern in expected returns and in the Sharpe ratio of returns. And note that this is consistent with the premise of value investing, right? So what we mean by value investing in a time series sense is that future expected returns are thought to be high when prices are low, right? And that's basically what we recover as well. So we recover counter-cyclical expected market returns for value investors. Now, this is the my favorite graph. So just compare the black line with the red line, right? It's remarkable. They're like exactly opposite. So the black line is the belief of the market investor about the stock market, and the red line is the belief of the momentum investor about the stock market, right? And it's actually remarkable how exactly opposite they are. So the correlation between the two series is like minus 85%. So now, this blue line here, which looks like a straight line, but it's not a straight line. So the blue line is the beliefs of the small growth investors. So the range of variation is small, so it looks flat, but it's also pro-cyclical. I'm going to show you a table. So basically what we find is that for the small growth investor and the momentum investor, they have pro-cyclical expected market returns and Sharpe ratio. So this is the expected market return and this is the Sharpe ratio. You see that both are basically counter-cyclical for the market investor and pro-cyclical for the momentum investor. So, and note that this pro-cyclicality is consistent with the premise of the momentum effect. Right? So a momentum effect is that the stock market is expected to continue to expand further in expansionary episodes and continue to contract further in recessionary episodes, right? So basically consistent with that, we find that momentum investors seem to have these pro-cyclical beliefs about the market return. Okay? And also I want to point out that, the disagreement between different investor types is in the expected returns, but not in the volatility, right? So if you see panel B, which plots the volatility, so the perceived volatility is counter-cyclical for all investor types. So the main dimension of disagreement is in the mean, which also, of course, translates into disagreement about the Sharpe ratio, right? So this is some, formal numbers. So this basically just summarizes the graphs in terms of calculating correlations between the recovered beliefs and the business cycles. So these are just correlations of the expected return with recession, of the volatility with recession, and then the Sharpe ratio with recession. So basically, you would see these are like negative for small growth and momentum, and they are positive for the market and the value. So I also I showed you right at the beginning that individual investor surveys tend to report pro-cyclical beliefs, whereas institutional investor surveys tend to report counter-cyclical beliefs, right? So in this table, we actually compute, so we use the 13F filings of companies to calculate the institutional stock ownership by size and book-to-market quintiles. Right? So basically what you will see here is that this small growth has the smallest institutional ownership, right? So basically you see that the vast majority of these small growth stocks are actually owned by individual investors, not institutional investors, okay? So this is also consistent with us recovering very different beliefs for these stocks compared to other asset classes. They are basically, from the 13F filings of all the companies, right? So we do it company by company. So from the CRISP CompuStat merged database, so we look at each company and we look at the institutional ownership of those companies, and then average them across all the stocks in a given portfolio to arrive at the number. I think this was based on like 2019's ownership structure. Yeah, so basically we couldn't do this for the momentum, so we could only do it for small growth. We couldn't do it for momentum because momentum has a short position and the short position data is not available, so we couldn't repeat that. Okay, so this is very quickly, so this shows because we recover beliefs for different investors, we can also show you the extent of beliefs distortions for the different investor types, right? So you see that here, this plots the clique divergence so it's the clique divergence relative to the physical data generating process. So it's the divergence between subjective and objective beliefs for different investor types. We see that the beliefs of the type B investors, so that's the black line. You see the black line is the closest to 0, right? So basically the distortions of the type B investor, which is the market investor, tends to be closest to the data generating process compared to the beliefs of the momentum and small growth investors. Okay? Now, how do we interpret this result? It's actually not very easy to interpret this result, right? Because you see, this does not necessarily imply that the type B investors are more rational than the other two investors. Right, so just because the type B's beliefs are closer to the physical doesn't mean that the type B is more rational, right? Why? Because the DGP may not be rational. Because the marginal investor who's setting prices and therefore creating the DGP may not be rational. So just because an investor is closer to the DGP doesn't mean that she's more rational than someone who's farther away from the DGP. Right. Now, also, at the same time, to the extent that investors are price takers, right, it may not be rational to deviate from beliefs that set prices, even if those beliefs are known to be not rational, right? So suppose I know that, Walter is setting prices, and I know that he's not rational, but given that he's setting prices, it's not optimal for me to deviate from that, right? So basically, this kind of complicated. So for these reasons, we refrain from making strong conclusions about rationality. And note that the divergence is counter-cyclical, right? So it clearly goes up during bad times. So this is my last slide. So this is this previous slide here was showing the divergence relative to the physical data generating process. So here, I'm going to show you divergence between different investor types, right? So this shows the disagreement between different investors. So the black line is the divergence between the market investor and the momentum investor. And the red line is the divergence between the market investor and the small growth investor, right? So basically, we see that investor types disagree more with each other during economic downturns. So the shaded areas are recessions. Okay, so this is also in line with analyst disagreements and so on that people have studied. Okay, I think I won't. I think it's good. I just summarize. So we have a novel methodology for the recovery of heterogeneous beliefs and preferences of different investor types from observed asset prices, which don't require assumptions on the physical data generating process or assumptions about investor rationality. And basically, we recover at least 3 different investor types, differing both in terms of risk preferences and beliefs. And finally, our methodology is quite general and may be applied to encompass other more exotic asset classes, such as currencies, commodities, private equity, venture capital, and derivatives. Thanks. Yeah.